Good afternoon, everybody. Thanks for joining us today. We're just going to give it about one more minute to let other people join, and then we will go ahead and get started. All right, it's 1 past the hour, so let's go ahead and get started. Thank you all very much for joining us today for our Home Equity Valuation Made Simple webinar. We're going to talk about how to balance speed, cost, and compliance when you think about your home equity valuation strategy. We'll start with some brief introductions. I'm Ashley Jelinek, the CEO here at Corporate Settlement Solutions. We are a real estate settlement services provider to regional lenders. So we offer a full spectrum of valuation, title, and closing solutions for regional first mortgage and home equity lenders. I will turn it over to Luke to introduce himself.
Good afternoon, everybody. Luke Tomaszewski, CEO of ProxyPics, based out of Chicago. I've been an appraiser for 20 years and started ProxyPics back in 2016 just to solve a need that we had in the appraisal world. So looking forward to the webinar. Thank you, Ashley.
Great. Thanks, Luke. Okay, so agenda for today, I'm going to spend about 10 minutes just giving an overview of the different home equity valuation products available to you, talking through a 3-step framework you can use to think about which products are right for you and how to use the right product on the right loan. And then I'll close by sharing some real-world data from what our CSS customers are using on their home equity loans. Then Luke and I will have a conversation about new technology developments in the home equity space, what Luke at ProxyPics is doing and how that technology can help all of us. We will have time for audience Q&A at the end. So please, if you have questions throughout the webinar, go ahead and put them in the Q&A or in the chat, and we'll answer whatever we have time for today. We'll follow up on anything else after the webinar, and then we'll take a minute to share some key takeaways and next steps. On the housekeeping front, we will share this recording and these materials with everyone in attendance after the call. So we'll send that out in the next few days. So moving into the product overview, we think about the available home equity valuation solutions in 4 different categories, moving from least comprehensive and lowest cost on the left to most comprehensive and most expensive on the right. And we'll just touch on these briefly here and then go into them in more depth on the coming slides. But on the far left side, you have the automated valuation model, or AVM, with the property condition report, PCR. So that's where you are sending someone out to inspect the property, but the AVM is using an algorithm and a model to value the property. There's not a human actually coming to that conclusion of value. It is compliant with interagency guidelines, and we typically see that with either an exterior or a virtual inspection. Moving to the evaluation product, now you have an analyst producing the conclusion of value. So you do have a human involved with that valuation, but it is not an appraiser. So it is compliant with interagency guidelines. And here you can choose from an interior, exterior, or virtual inspection. Moving to the hybrid appraisal, this is where we get the appraiser involved. So they are not the person going out to inspect the property, but they are the person valuing the property. And as a result, it is USPAP compliant. And again, you have multiple inspection options. And then on the far right, we have the full appraisal, the most comprehensive option that we're all familiar with, where the appraiser is inspecting and valuing the property, USPAP compliant interior or exterior inspection. So we're going to go into each of these 4 options, talk a little bit more about what you can expect in terms of cost and turn time, and some key considerations to think about when deciding whether or not you want to use these products. So starting with the AVM PCR, turn time should be instant for the AVM, and we're seeing about 1 business day for PCRs. On the cost side, typically $15 to $20 for an AVM, That's going to depend on whether you're using an individual model or a cascade, which we'll talk a little bit more about in a minute, and then 50 to 70 for a PCR, depending on what type of inspection you're ordering. So key considerations here, from a regulatory standpoint, you can use an AVM on loans up to 400K. It is compliant with interagency guidelines as long as you're using it on loans below that amount, and as long as you're pairing it with an evaluation of the physical condition of the property. So that's why it's important to get that PCR along with your AVM. At CSS, we always recommend using an AVM cascade rather than a single model. And the reason for that is that individual model performance, even in the best models, varies significantly by counties and varies over time. So AVmetrics, which is a high quality third-party AVM testing source, looked at the best AVMs in the country by county, and there was something like 15 different models that performed best depending on what county you were in. So what the cascade does is it's going to take 15 or so top models, test them in every county, pick the top performing models, and then every property in that county is going to cascade through those models. We also recommend that this cascade be independently validated by a qualified third party on a regular basis. So at CSS, our cascade is validated on a quarterly basis. And that's just going to make sure that you as a lender are getting the highest quality results from your AVM in terms of accuracy and hit rate. We also wanted to note that there are new AVM guidelines for both accuracy and bias that are currently scheduled to take effect this October. There's been some speculation that the current administration will roll those back, but as of now, they're still on the books. From our perspective, the accuracy guidelines are not much different than what already exists, and all the top providers should easily comply with those. The bias area is a little newer, a little bit more of an evolving space, and the guidelines don't really spell out exactly what you need to do. But all of the providers we work with are actively working on this, have an approach in mind, or they've already done the testing that is needed. So we're not concerned about any of them complying, but it is a great question to ask your AVM provider what their plan is to make sure they're compliant in advance of October. So overall, AVMs are ideal when speed and cost efficiency are critical. Obviously, this is the quickest, lowest cost option in a home equity world where you're often eating the costs of your valuation products. This is a good option to have on hand if you really want to bring those costs down. But then from a risk and compliance standpoint, we recommend using these on low risk loans. We'll talk a little bit more about what that means later, but not appropriate for every loan. Another circumstance where it might be a good option is a property where you have a recent appraisal on file. Moving to the evaluation, here you're going to see a turn time of about 2 to 3 business days on an exterior inspection, 3 to 4 for an interior. Typical cost we're seeing is about $160 for an exterior evaluation, $210 to $220 for an interior. So about double the AVM PCR combo, a little bit more than that, but significantly less expensive than a full appraisal. So if you're a lender who's using a lot of full appraisals right now, this is a really good savings opportunity for you. Considerations on this product: you have a qualified third-party inspector going out and inspecting the property, and then you're getting a conclusion of value from a trained analyst. You can use it on loans up to 400K. It is compliant with interagency guidelines as long as you're completing it by a qualified independent personnel. So obviously there's a lot of evals out there from a lot of different vendors, and a couple things you want to keep in mind when deciding which one to use. The first is that analyst. How are they being trained? How are they being managed? How is their work being reviewed? And how is the provider ensuring that they are independent from the lending decision? The next things to think about is at CSS, we use an evaluation product that's completed on a form similar to a 2055. So it's got the comp grid, it's got the adjustments. We really like that because often our lenders' underwriting staff are used to that format. They know how to interpret it and work with it. And it just makes it easier for your team, given that you're likely still going to be ordering some appraisals, to have an eval that looks similar. We also use and recommend a product that includes extensive market analysis. So some of the newer products on the market have really good data included in them, actually beyond what you would see in a traditional appraisal. So things like extensive price and listing history, showing up to 30 additional comps and listings that the analyst took into consideration that don't show up on that comp grid, data on the market like months of supply, home price trends, price per square foot, just a lot of extra information to help your staff interpret the results. And then one thing our product has that we also recommend is the option to contact the borrower directly for additional information. So in areas where public data is limited, this is a good way to increase your hit rate by getting that subject property data directly from the borrower. Overall, we really like this product. We think it's significantly more comprehensive than an AVM because you do have that trained analyst involved, but the increase in cost and turn time is fairly moderate, especially compared to a full appraisal. It's also a really good option for geographies with limited appraiser availability. So not as much of a challenge in today's market, but when we think back to 2021, times when the first mortgage market is really going strong and there's a limited pool of appraisers, this is a great option to bypass that and make sure that your turn times aren't impacted. Next product we have is the hybrid appraisal. So here your turn time typically goes up about 1 business day. So we're looking at 3 to 4 business days for an exterior inspection, 4 to 5 for interior, looking at a cost of low 200s for an exterior product, high 200s for an interior. So definitely more than the evaluation, but still about 50% of a full appraisal cost. And this is very similar to the evaluation product, except that the conclusion of value is coming from a licensed appraiser. So it is USPAP compliant. We recommend all the same things as the eval when you're thinking about which hybrid to select. So what type of form is it on? What kind of market analysis does it have? Does it have the option to contact the borrower directly? And we think this is a really good option for lenders who, from a risk and compliance standpoint, are just more comfortable having an appraiser valued product, but they still want to reduce their costs and turn time versus a full appraisal. So moving to that full appraisal product, which I'm sure we're all very familiar with, typical turn times we're seeing 4 to 5 business days for that 2055 drive-by, 5 to 7 business days for the 1004 interior exterior, typical cost of $500 to $600 or more, depending on your geography and the property type. So obviously a significant cost in a home equity world where you may be absorbing that, or maybe you're passing it along to your borrower, but that might be hurting your competitiveness. So things to think about here, obviously it's the appraiser inspecting and valuing the property, so it's USPAP compliant. We always recommend you should have the option to either use, if you're using an AMC, either using their network or using your own panel of appraisers if that's your preference. And we really recommend limiting the use to higher risk loans. So high loan amounts, high LTV, unique or complex properties. In our experience, a reasonable goal for most home equity lenders and the national benchmarks that we see are to limit full appraisal usage to 20% or less of overall loan volume. Not possible for every lender depending on your portfolio and your geography, but on average, that's a great benchmark to shoot for to make sure that you're optimizing your costs and your turn time. So now that we have gone through all the product categories, let's walk through a 3-step process of deciding which products you want as a lender and what loans to use them on. So the first question is, which of the 4 categories do you want access to? And typically the answer is multiple, if not all of them. The biggest challenge we see when talking to lenders is that they're going straight from an AVM to a full appraisal with nothing in between. And that often represents a missed opportunity to improve the process from a cost and turn time perspective. So I highly recommend for the majority of lenders that you should have either an eval or a hybrid, if not both, in your toolkit. So here are some questions to think about when making that decision internally. The first is, do you have specific cost or turn time reduction goals, whether that's for borrower satisfaction or internal efficiency? Are you trying to get to a 7-day application to close? Then you probably want to use AVMs pretty heavily. If that's less of a priority for you, you may not need to go to that level, but you want to start by thinking about what your objectives are. The next is, which products are you comfortable with from a risk and compliance standpoint? So that's both internally as the lender and then also externally if you're selling these loans to investors. We work with lenders who are comfortable using AVMs on 80% of their home equity loans. We work with lenders who will not use AVMs or evals on any of their loans. Both are fine, but you want to make sure you know where your institution stands before you choose your product. Definitely recommend taking a look at your typical loan amounts, LTV ratios, borrower risk profiles, and thinking about how they align with the product. So if you're doing a lot of low dollar loans, low LTV, borrowers with good credit, cookie cutter properties, that's great for an AVM PCR. If that's not the case, then you probably want to go to one of the products that are more comprehensive. And then finally, what states are you lending in? There are state-by-state nuances of this product. We work a lot in West Virginia, and the evals and hybrids are not widely accepted there. And it also depends if you're lending in an urban or a rural or remote community. If it's urban, typically a great use case for AVMs. If it's more rural or remote, you're likely to have those complex properties that might need an appraisal, or you might be a great candidate for the eval because there's likely a limited pool of appraisers in that community, and you're going to bypass that with the evaluation. Once you figure that out, the next step is to think about, in each of those categories that you want, which specific products should you use? So obviously, like I mentioned, there's a lot of vendors out there. There's a lot of different products. So here are a few factors to help you sort through that. One is, how much does it cost? That's obviously a factor. But you also want to know, what are the recent turn times and hit rates in your specific geography? So just like the AVM can have a no hit, the evaluation and the hybrid can also have a no hit. So you want to know from each provider, what does that data look like? You also want to know what format the report uses, going back to our conversation about, does it look like a full appraisal or not, and what data is included. Are you going to get a comp grid with adjustments, comp photos, market analysis, etc.? Definitely important to think about if the vendor offers an integration with your LOS. Obviously, that's going to make you more efficient internally. And then ideally, you're finding one vendor that offers all of the product types that you need. So it's fairly inefficient to have to go to 4 different vendors for AVM, evaluation, hybrid, and appraisal management. You really want one that provides all of those products. And then lastly, thinking about, is the vendor creating the products in-house, or are they offering the best-in-class products from a variety of vendors? So that's the approach that CSS takes. We are not creating these products in-house. I'm not the expert on a PCR, that's Luke and ProxyPics. I'm not the AVM expert. So we like to go out and partner with those best-in-class providers, package them together for our lenders so that they have one consolidated way to get all those great products without having to do the legwork themselves. And then finally, once you have your products, you need to figure out internal guidelines for which product you're going to use on each loan. And that's going to vary by lender, but at a high level, when you think about the AVM PCR, you have to be under 400K from a regulatory standpoint. Some of our lenders go lower than that, right? You might only be comfortable with 250. It's going to depend on the lender, but you want to decide internally what that dollar amount is. Typically, we also recommend this for lower LTV ratios, lower risk borrowers with strong credit profiles, properties in stable, easy to compare market areas, and then properties where you have a recent appraisal. For the eval, you still need to stay under 400K, but because you have a trained analyst involved, now we think it's generally appropriate to go up to more of that moderate LTV, moderate risk borrowers, still likely renewals or line increases with a limited collateral risk, and then properties in areas where there is limited appraiser availability. For the hybrid, you no longer have that loan amount limit since it's USPAP compliant, so okay to go up to those mid-sized loans, moderate to higher LTV ratios, moderate risk borrowers, and any collateral where you just really want an appraiser involved. And then finally, the full appraisal, like we talked about, this is a great option for those large dollar home equity loans, substantial line increases, high LTV ratios, higher risk borrowers, or properties that have unique characteristics like acreage or waterfront, things that are going to create a limited set of comps or a market that's been really volatile lately. So I'll close this section with just sharing some of the real world data from our lender customers. So we took a look at 40,000 home equity loans across 20 of our customers in 2023 and 2024. The blue bar is 2023, the green is 2024. So starting on the far left with the AVM PCR, you can see that this is the most widely used product among our lender customers. So in 2024, we saw 34% of the loans valued by an AVM PCR. The MBA also did a home equity lending study last year, and they found nationwide, at least in their cohort, that 43% of home equity loans were valued by an AVM. So we definitely see that as a widely used product that is growing in usage. The next most used product among our customers is that appraiser valued hybrid. So about a quarter of loans last year, and a lot of our lenders like that it does still have appraiser involved, but it's a lot cheaper and quicker than a full appraisal. Next two sections are the full appraisal, the 1004 and the drive by 2055. That makes up about 30% of our customers' loans. The national average, according to the MBA, is 22%. So our lenders are a little bit more conservative than the average, which makes sense because we're working with regional community lenders, but still pretty close to that 20 to 25% benchmark we talked about. And then the non-appraiser valued hybrid at 11%, that's that evaluation. And we honestly think there's a good opportunity to increase the usage there because we think it's an underutilized product in general that lenders don't always consider. And the last thing I'll say on this is this does hide a lot of variation across lenders. So we have, 7 out of these 20 lenders are using AVMs for more than half of their loans. We've got a couple lenders using a hybrid appraisal on 80% plus of their loans, a couple using evals on 80% plus, and a couple still using fulls on everything. So we see a lot of variation across lenders, which also speaks to potential opportunities to, optimize product mix. So with that, I will turn things over to the conversation with Luke. I'm going to stop sharing my screen. And, Luke, I'd love to just give you a minute to explain ProxyPics, your product, and your technology as it pertains to home equity lending.
Yeah, of course. Great. Thank you, Ashley. So ProxyPics, the simplest way to really think about it is really the Uber for photos. So the concept that I was trying to solve, back in 2016 is when we launched the company. The idea really came into my head back in, '08 when we were doing a lot of REO work. Simple concept that I was trying to solve is getting an exterior inspection nationwide in 24 hours or less. An inspection company is not a new concept by any means, but the problem that we ran into, back in '08 was just getting an exterior inspection could take 5 to 10 business days, depending on the geography. If you fast forward to today, in the home equity world, everybody's looking to, close something faster. The younger generation with, the Amazon effect, as we call it. If I'm applying for a home equity loan today, I'd like to close on it tomorrow, the day after. I don't want to wait a few weeks. The biggest pain point was really that inspection. As you mentioned in the earlier slides, the AVM is instant, but verifying the subject condition with that PCR is usually the most time consuming part of it. So that's really what we've been able to solve for, our partners, and it's been going really well so far.
Yeah, we are always very impressed with your turn times, and our lenders love getting those back in a day. So we appreciate that.
Thank you.
Let's talk a little bit about virtual inspections. That's something we've heard a lot about since COVID, but frankly, among our customers, haven't seen a ton of adoption. So I'd love to hear a little bit more from your perspective about how that technology works and what you're seeing in terms of adoption.
Yeah, it's a great topic. So like you mentioned, during COVID, we developed something called ProxyPics Direct. It was a borrower-enabled self-inspection, application. The way that the app would work is you could actually send a white label text message to the borrower. They'd click the link, download an app, and walk through the necessary steps of taking a photo, answering a few questions. And that worked pretty well. One of the wish list items from our clients was it'd be nice if the borrower didn't have to download an app. I think everybody has a few too many apps on their phones, and it just makes for a better borrower experience. So mid last year, we actually built out a fully web-based application for self-inspection. The benefit with that is once the borrower clicks on that link, it'll open up the app. It's actually a web page, but it functions just like an app. So they don't run into the headaches of having to download something. It's compatible on every device, and we can white label for the client too. So going to have the lender's logo, the lender's colors, so the customer experience is that much easier. And really, to finish that off, the experience has to be easy for that borrower. If it's a complicated way to fulfill that inspection, they simply won't do it. We used to see a lot of resistance from borrowers to do this self-inspection. Now they're actually embracing it because it's so easy. One, you're simply clicking a link, it's opening up immediately. We'll have pre-labeled photos like a front photo, a kitchen photo, so it's really easy to take. And now we actually have front-facing rules, leveraging AI, so it'll instantly tell you you took the right photo or you took the wrong photo, please retake it. So we've definitely seen an uptick in borrower direct engagement from the lenders because of that.
Yeah, that's great. And how do you make sure, they're in their actual property? It's the property we're trying to lend against. What protections are in place there?
You don't just trust the borrowers always. We have a lot of security, and that's been, the staple for us since day one. So we have some very simple things that we do right out of the box. We have geofencing technology. All that simply means is we're actually setting up a virtual fence around the subject property. If our data collector or if it's the borrower self-inspecting, if they're outside of that fence, they just get locked out of the app and they try to take that first photo. They get an error message saying that they're too far away. When they're within that geo fence, every time they take a photo, we're actually embedding metadata, which is the long and lat of where they stood to take that photo. And we're actually overlaying that little pin drop on a satellite map. So you could actually see where they stood when they took that photo. Any photo being taken has to be taken within our app. You cannot access the camera roll for prior photos. And lastly, we've seen people trying to do things like taking a photo of a computer screen. So we're actually running, pixelation on that, and it'll tell if it's a non-authentic photo, and then we get flagged for those. So people are always trying to, do certain things, and then luckily we're very our dev team's paying, close attention to that on, what some of those workarounds could be, and we're preventing those in the future always. So those are some of the things that we're doing in the background.
Perfect. Great to know those protections are in place.
Oh yeah, it's needed.
Yeah. And you touched on this a little bit, but obviously hot topic in any industry. When you think about AI and specifically computer vision, how are you building that into your technology and what benefits does that provide?
Yeah, it's definitely the hot topic right now. So what we want to do is, we want to spend the least amount of time on site so we're not inconveniencing that borrower, or if the borrower is self-completing, we want to make that process as easy as possible. So if you think before machine learning AI, the simple process was take a photo and then maybe fill out a questionnaire. So it might be take the kitchen photo, and then you'd have a drop down of, what's the countertop type, the flooring type, what appliances are present, things like that. We took a deep dive into machine learning about 2 years ago. We actually hired a machine learning scientist to help us understand how all of that works. Our intention being, spend less time on site and get the most accurate information as possible. Very time intensive to, train those models where you had to take a photo of a bathroom and draw bounding boxes around the toilet and teach the model, this is a toilet, this is a sink, and so on. The last year and a half with AI, that's become a lot easier with fine tuning these models where you don't have to have thousands of photos, drawing the bounding boxes. So what we've been able to do is really have real time interaction with that borrower, letting them know once they take that front photo that yes, this is the right photo. Um, Even with sample photos, this has nothing to do with AI, but a borrower might not know what a furnace or water heater looks like. So we're very proactive where before they take that photo, we'll actually show them a sample photo of what a water heater looks like. They take that photo. If it's the wrong photo, the AI is front facing for them. Within about a second, it will give them a response of, hey, you took the wrong photo. It looks like you took a photo of the furnace. Please retake the water heater. So things like that. So it's just easier for the borrower to engage and use the product.
That's great. Yeah, sounds very valuable for sure. Any other technology we should be thinking about or our lenders should be thinking about when it comes to home equity valuation and improvements that we expect going forward?
So it just comes down to speed and I think the accuracy of the data, especially as it relates to home equity. So we have, FDIC, OCC regulated lenders that, still are a bit more comfortable with, that third party inspector actually going out, performing that PCR, whether it's interior or exterior, and then merging that with an AVM, as you said. And then we'll have the, total opposite of the spectrum with these fintech enabled lenders where they want to take advantage of, the lowest cost products that are still safe and viable and the easiest for the borrower. So they're typically opting in for that self inspection process. So really just the AI has been very helpful in that where, some of the issues that we had in the past before implementing the, instant review would be a borrower taking the wrong photos, our team having to manually review that and then send it back to the borrower a few hours later. That's just a point of frustration that you want to avoid at all costs. Even on the appraisal side, we never want to reject something back to an appraiser if it get prevented on the front end. With the borrower, it's that much more concerning because they're communicating directly with that lender partner. So as easy as we can make that process for them, that's the goal here for us.
Yep, that makes total sense. I mean, where do you see this all headed? So we saw the increase in AVM usage just year over year and the national trends. Do you think that's going to keep going? Are we still going to have appraisals in the home equity lending space? What do you expect that to look like?
So, just like you said, an AVM is not perfect for, and every property type, every location. So I definitely think we'll see an increase in that. I do think the AVM providers are getting better. We'll start seeing, condition-based AVMs based off the PCR information that we're providing so they could actually adjust those values. I think everything that we're seeing right now, the AVMs is just assuming an average condition. So that'll be the next step will be these condition-based AVMs. But I don't think appraisers, will go away by any means. I just think we'll have different properties to appraise where we're actually needed. If you're in a typical, cookie cutter subdivision with, two model homes and a lot of sales, um, you really don't need an appraiser in that scenario. An AVM will typically do a good job, especially if it's a low risk loan, like you said earlier.
Yep, agreed. And I do think those condition adjusted AVMs are going to be really interesting to see going forward and a nice advancement for our lenders.
Yes.
Any, typical concerns you hear from lenders when moving to a virtual inspection or moving to a PCR, things that you have helped them overcome in the past?
So I'd say the biggest concern for the self-inspection side was that opt-in rate for the borrower. So typically lenders or even, we work on the insurance side, we've always heard that the adoption rate's been really low. We see about an 80% adoption rate, if not higher. So when we launched the, web-based app, that drastically picked up that rate for us and just the ease of use for the borrower. So that was always a concern. Security is obviously a very big one. So we need to guarantee that, the photos that we're providing or the actual subject property, they're not being altered in any way. So we go through a lot of testing with, lenders, the GSEs, even credit rating agencies to look at our technology, analyze it, and provide feedback. But it's definitely being more accepted at this point. If we had this, conversation 2, 3 years ago, a lot of hesitation, but now every lender's starting to see the efficiency. They're seeing some of their competitors leverage products like this, offer, quicker turn times to close those loans, less friction for the borrower. And I think they're starting to see that they have to, start engaging in products like this to stay competitive. Otherwise, you fast forward a few more years and you might not be the home equity lender of, choice in that region. So you really have to keep up with what the competition's doing at this point.
Yep, absolutely agreed. Before we turn to audience Q&A, any other product enhancements or features that you want to make sure our lenders know about that ProxyPics has coming down the pipe?
So that condition-based AVM. So we've got a partnership that will be launching, pretty soon that we'll make public there. We see a lot of need for that where, the AVM providers are doing a great job, but this is really that next iteration that's needed is that condition-based AVM. Not only will it provide a more accurate value, but we're going to see a lot of benefits to, those loan pool sellers where they're actually selling those loan pools if you have a more accurate value based on that. So you'll have things like that. And then, internally, this is not lender facing, but we just launched a little AI chatbot for our proxies in the field just for quicker responses. And one of the ways that we're leveraging, the newest technology here just to make everything, more streamlined, faster, and better is really the name of the game for us here.
Great, that sounds good. Let me take a look at audience Q&A. If anyone has any questions they'd like to ask, please do put them in the chat. One for you, Luke, is how do virtual inspections impact turn time? So if the borrower is slow to respond, or if the borrower is that 20% that opts out, do we then expect longer than a business day turn time, or is it typically not a negative impact there?
Typically not a negative impact. We're seeing, turn times typically within that 24-hour time frame for borrower enabled. A majority of them are typically within about 80 hours for about 70% of the self-inspect that we see. So very quick turn time on those. The nice thing with our model is you'll typically see companies that either, specialize in virtual, inspection only, or they run their own panel. The benefit with our services, we offer both, under that one roof. So we'll have, some lenders that opt in for the self-inspect at first. If the borrower doesn't complete that in X amount of time, we could actually rotate that to a third-party inspection, just some rules that we set on the back. But then we have, follow-up messaging with that borrower. So one of our clients, will send the text message to the borrower. If that inspection doesn't go into a completed status in 24 hours, they get a reminder text message. And then on day 3, we might upgrade that to an X tier PCR. And that's been working really well for a lot of our partners here.
Great. Yep, that makes a lot of sense. Okay, one that I'll take is, what happens if the initial valuation product doesn't work? So I mentioned there are no hits on these products. So what happens if your eval comes back as a no hit or your hybrid? And so at CSS, what we do is we talk to the lender ahead of time and just agree on the rules. So some of our lenders say if it's an AVM no hit, I want to look at it and decide what product to order next. Some of our lenders tell us, go ahead and automatically upgrade it to an eval or to a full. Same thing with if the eval or the hybrid is a no hit, we can agree in advance to upgrade it. So that's one of those benefits of getting all of your products in one place is you don't have to go order it from someone else. And then one last question for you, Luke, is just, how do you double check the accuracy of the computer vision? We've all heard about the computer getting things wrong or not interpreting a photo correctly. So how do you make sure that's not happening in your app or your web-based inspection tool?
That's a great question. So obviously it's a lot of testing, that we have to keep doing, but a simple example that I like to give is a photo of a garage. So simple as it sounds, we actually have a 3-tiered approach where we'll actually get the photo of the garage, the human in the field, the proxy will actually, fill in that it's a 2-car garage. We'll have the AI overlay saying it's also a 2-car garage. And then we're also pulling in an MLS and assessor feed. If that also agrees that it's a 2-car garage, then we'll proceed without, reviewing that manually. So that's how we're actually doing it. If we have, 3 independent sources that agree with the exact same thing, then it'll fly through a review. But if there's one part of that, review that disagrees, and let's just say MLS comes back saying it's a 1-car, then we'll actually have a human reviewer looking at that. But it comes back to, lots of reviews. So every month, we're looking at some of the failures. Going back to that garage example, when we initially launched, the AI to actually review these things, God, our success rate on, accurately describing how many car spots the garage had was probably 20%. And we very quickly learned to why, we were pushing, too many photos to the AI where we'd send, the front of the house, the garage photo, the street scene to answer this one question about how many car stalls are in there. We very quickly learned, the AI is looking at that street scene, seeing, 40 garages down the street, and it's getting confused. So you really have to trim down what the actual algorithm's looking at, and then fine tuning that model afterwards. But it just goes back to, lots of testing, seeing where the failures are, trying to identify those, and then fix them moving forward.
Great. That makes a lot of sense. Thank you. So let's move in the last few minutes to some key takeaways and next steps before we conclude. All right, so a couple of key takeaways from what we talked about today. Important for lenders to have multiple home equity valuation products in their toolkit, and those should be tailored to your own objectives, but ideally you're not just relying on full appraisals, you're looking at the full spectrum of valuation options. And then very important also to match the correct product to the appropriate loan so that you are balancing those speed, cost, and compliance concerns on every loan. There is an opportunity to save significant time and money by selecting the right product and minimizing use of full appraisals. So we saw that going from a full appraisal to even a hybrid can save 50%. You go down to that AVM, you're saving more like 80%. So a big opportunity there. And then finally, the potential to leverage modern tech developments like the virtual inspections and computer vision and condition adjusted AVMs that Luke spoke about to streamline and enhance your valuation results. So, the role that CSS plays, how we can help, is we view ourselves as an unbiased evaluator of third-party valuation solutions. So we have gone out in the market and found great partners like Luke at ProxyPics that are doing great things with technology, and we package all of those solutions together so that our lender customers can receive the products in a consolidated and integrated manner from one specific vendor. So in terms of next steps, if you'd like to have a deeper conversation about these topics, have us take a look specifically at your valuation process and products, get some guidance on the best way to incorporate some of these solutions into your workflow, we're always happy to chat further. My contact information is here. You can visit our website to learn more. And like I said, we will distribute the materials and the recording after today's call. Thank you all very much for your time today. And thank you so much for joining us, Luke.
Great. Enjoyed the conversation. Thanks again, Ashley.
Yep. Have a great day, everyone.
Thank you. Bye.